Hello, welcome to Private Market Talks. I'm your host, Peter N. Tushik. Today, I'm talking with Sengal Salesi, co-founder and CEO of Brightwood Capital Advisors. Brightwood Capital is a private credit fund headquartered in New York. We've covered a number of private credit funds, but what makes Brightwood unique is that it invests in founder, family, and entrepreneur-owned middle market businesses that form the backbone of our economy. Sengal talks to us about how this investment strategy drives Brightwood's underwriting and risk management, as well as how he has built the investment team. He also discusses the opportunities and challenges faced by these founder, family, entrepreneur-owned businesses. I think you'll find this to be an engaging and thought-provoking conversation. And as usual, you can get a transcript of this episode, as well as links to other useful information at privatemarkettalks.com. And with that, here is my conversation with Sengal Salesi, founder and CEO of Brightwood Capital Advisors. Sengal, welcome to Private Market Talks.
Thank you, Peter. Happy to be here.
I appreciate it. I'd like to start off by getting a little background about you and the origins of Brightwood Capital and what inspired you to start Brightwood Capital.
Sure. In terms of background, born and raised actually here in New York City, so stayed at home and started my career in investment banking, first with Goldman Sachs and then Morgan Stanley. And then about 25 years ago, went into the principal investing side with SocGen, who was starting a merchant bank that would do private equity and private debt investments into the same companies that we invest in today. And so had a nice 12-year career there where I rose to ultimately run the U.S. merchant bank for SocGen. And then, as we've seen in many forms throughout the private credit industry, the banks decided to get out of the direct space. And so in 2010, spun the business out and then ultimately started Brightwood then. Interestingly, in the choice between private equity and private credit, which we had done both of before, I thought the real opportunity set was in the credit space because there were a number of middle market private equity firms, but with the transition going on in the lending market, not as many firms who were capable of providing the leverage to these structures. So that seemed like the opportunity at the time. And 2010, the world was a very different place. We were coming out of the GFC. Capital was quite scarce. So in some ways, it would seem like not the right time to start it, but that in hindsight always is the best time when there's not a lot of people going into the space. So we were one of the early players in the senior direct lending area and have been there close to 15 years currently.
And so today, fast forward, what is your assets under management and the number of investments that you have currently?
So we have more than $5 billion of assets under management, just pursuing this one strategy of U.S. middle market direct lending. And since we've started, we've deployed capital to more than 250 unique borrowers and deployed more than $12 billion into the space.
And so what makes Brightwood Capital unique in the ecosystem of private lending?
Mm-hmm. Yes, and I think you touched on it in your opening, Peter, but one of the things that makes us unique is we lend to both non-sponsored, which we call family founder and entrepreneur-owned businesses, as well as private equity-backed businesses. And I'd say the vast majority of the industry really focuses only on the private equity buyouts, and we think there's a huge opportunity in the non-sponsored markets. That's one of the areas that makes us unique. Secondly, we focus on 5 core industry verticals. So we're specialists, not a generalist, where we spend all of our time. And those are healthcare services, business services, tech, telecom, transportation, logistics, and franchising. And we think it's better to be focused and know your verticals and domain very well versus more of a generalist. And then the last piece is I think we seek to be a value-added partner to the companies that we partner with. So not just providing capital, but providing operating resources, industry networks and the like to our portfolio companies. Somewhat different, we think, than your traditional direct lender.
We've had a number of private credit lender representatives on Private Market Talks, and most of them, as you point out, many in the industry focus on sponsor-backed companies. Mm-hmm. The fact that you're focused on non-sponsor-backed companies, I find really interesting, and I would be curious on a number of levels. First, why? Why did you pick that sector when in some ways doing sponsor-backed deals may be easier?
No, it's a great question. And look, absolutely, from a sourcing perspective, sponsor deals are a lot easier. They come with sort of your package neatly wrapped up in a bow from the private equity firm. And you know there's transaction certainty because the majority of sponsor lending is usually to fund an acquisition or a change of control where there's a transaction that is expected in a finite time period. In terms of why we do like the non-sponsored area is, and again, we do it 50-50, non-sponsored and sponsored, is when you look at the middle market, that really reflects the ownership that you see in the middle market. Only about half of the companies are sponsor owned. Now, interestingly, from a private credit perspective, they do generate about 85% of the direct lending business.
Right.
And why is that? Private equity firms use much more leverage than family-owned businesses. It's core to how they drive their returns. And if they want to generate 20% for their LPs, they're not just doing that on the asset level. Leverage is critical to doing that. So they tend to leverage probably 2 to 3 times the level that you'd see in a family-owned business. And then the second thing is the change of control, which you don't have in family-owned businesses. Every time there's a buy or sell, that creates an additional level of volume that you don't have in the non-sponsored world. So it is the vast majority of direct lending. But when you look at the underlying companies, it's about 50-50. And so we actually wanted to cover the broader segment of the middle market and to fish in a bigger pond, so to speak. And so we really look to find the best businesses in our verticals, whether they happen to be owned or not by a private equity firm. And we don't need that private equity firm there per se to do a transaction. In some ways, our DNA from the merchant banking world, where we did do private equity and private debt, we were comfortable analyzing the equity without an equity player there as well. So I think it somewhat comes from our backgrounds and skill set.
So I love the fact that you do both. Mm-hmm. And it allows you to compare and contrast the differences between the two, which you've laid out some differences. But I'd like to peel that back a little bit more. And I'd love to hear from your perspective some of the differences beyond what you've described so far in terms of underwriting, sourcing, underwriting, and managing a non-sponsored transaction.
Sure. And look, there are a number of differences. To maybe start with the sourcing, it is, we'd think, more difficult to source the family founder entrepreneur-owned businesses for a couple of reasons. Each deal is a bespoke deal. You're not going to get 3 or 4 deals in a fund from an individual private equity firm. So you do have to cast a much broader net. You need to be local. You need to be known to these companies.
So how do you go about that?
So we do it in a number of ways. We're not, even though we're based in New York, we do have professionals in Chicago, Los Angeles, Dallas, Austin. So we want to not just be centered in our home market. While most private equity firms are headquartered here, so it's easy to do that if you're just a New York direct lender. Secondly, a lot of the folks who we partner with are spread in even more cities, so probably 20 cities. And so we're very referenceable in the local business communities for those, because a family-owned business is not going to take a cold call and say, we can save you 100 basis points on your loan. So, go with us. They really want somebody they know and they can reference. And so it also goes to the type of originator we have, who's a very experienced professional, typically 20 plus years of experience, who comes with relationships. So about half of the companies that we've lent to, you could actually tie a pre-existing commercial relationship between the borrower and that individual, even before they were at Brightwood. And then you have to talk to the law firms, the accounting firms, the advisors to these businesses, and it helps being industry focused from that perspective, both from an offensive and a defensive perspective.
What do you mean by that?
Yeah. It's interesting. I think you need to do that to be able to do FF&E lending, because when you lend to a private equity backed business, you can be a generalist because the private equity firm is bringing that domain knowledge, and you sort of have the warm blanket of the PE firm. When we're doing that, we, again, like the differentiation there, but we have to bring a lot of that value. The companies we're lending to are companies that are often getting called by private equity firms multiple times a week looking to buy their businesses, but they want to keep them as independently owned businesses. But they realize there's value from an institutional partner. And so we seek to again, be more of that value-added partner than just a capital provider where the PE firm is providing that value. And
so you have a lot of industry experience
yes,
that you're able to bring to bear.
Yes, and so that's why you need that industry experience. But from the offensive side, look, it allows us to be present at a lot of the industry, where industry folks gather for those, the conferences, the thought leadership areas there, and to be a known player in that space. And so that does make it easier to originate in our verticals, is that we are focused on those areas and we're well known and we are very visible and present.
And then take me to the next step from origination to underwriting.
Sure.
How is that different?
Sure. Yes, from the underwriting perspective, again, very, very, very different. I think one of the nice things on the family founder entrepreneur side is that there often isn't a fuse in terms of PE firm has a 30 or 45 day exclusivity to get a deal done. And by definition, you're only going to get as much diligence done as you have time to in that case. Typically, there is, so I think about 2/3 of sponsor lending is change of control, acquisition finance. That's only about a quarter of what we do.
Right. And you get a nice, neat legal memo and diligence package from the sponsor.
Yes. So we're doing a lot more primary diligence, a lot of going through work papers, spending time with the management team. I think one of the things we like a lot is that direct relationship that's built with the leadership of the borrower. We often have board observer rights in probably about half of what we do, and we become a trusted partner of the borrower. In the PE context, typically very different. You often will get a management presentation before the transaction, and then afterwards, 90+% of your dialogue is with the sponsor, and you don't. And what I like to say is, family-owned businesses choose who they partner with, and so there is there is sort of a courtship phase, a relationship phase, but we enjoy that. I mean, we enjoy getting close to the businesses that we partner with, and really bringing the benefit of the breadth that we see across from multiple players in the space to help them in their business.
It's interesting you talk about building that relationship. You mentioned the timeline for a sponsor deal can be very compressed. How long does it take to build that type of relationship before you actually get a transaction done?
It can sometimes take years. As we said, a number of them are pre-existing relationships that date back 10 or 15 years. Now, since we are known within our industries, we are easier to reference. So you might have somebody who becomes through a trusted source for the company that can progress, maybe as in as short as 60 days, but often it's meaningfully longer. But where I'd say you really see the relationship blossom is after we make the initial loan. So about a quarter of each fund are repeat borrowers from prior vintages. And so the nice thing is, although non-sponsored deals are more difficult to originate, they tend to be longer lived because a PE firm by its charter has to sell a business after 3, 5, or 7 years. And chances are, even though it's easier to originate that deal, you'll lose it because if it sells to a strategic, they usually don't use private credit, or if it sells to a PE firm that has different relationships, you'll lose it. So there are a number of companies where we've led three or four different facilities for, because once we become their lender and we really show that we're a good partner, there isn't that sale at the end. So, and the average tenure of our business is about 30 years old. So these are long-term companies, long-term relationships. There's always a question, well, this Brightwood says they'll offer value, but do they offer value there? And if we're doing our job well, we really build that relationship, and it has a lot of add-on effects to the initial investment.
So it's in some ways a more stable portfolio as opposed to the turn that you might see in a sponsor.
Correct. And look, I think in an environment like this where PE firms are driven primarily by acquisition finance, which really for the past 13 years, from I'd say the end of the GFC in 2009 to 2021, probably went up 8 to 12% per year. So you got a 4 or 5-fold increase in M&A. In the current environment, M&A has fallen about 50% over the last 2 years. And so the diversification and the ability to build a diversified book in a PE only lending fund is a lot less. And so we like the fact that we have the broader pool. So we're still generating very diversified portfolios because we're not just tied to the M&A market. So it does build longer relationships, but it also, we think, helps in our portfolio construction.
Got it. How do you think about documentation as compared to a sponsored deal and a non-sponsored deal? Is there a difference?
I'd say there is. I'd say the non-sponsored deals kind of look like the credit agreements we grew up with 15, 20, 25 years ago. Very tight documents, structured, appropriate cushions, but tighter cushions than what you see now in the private equity world is moved to market as about a 30 to 35% cushion to plan before covenant is tripped. The definitions of EBITDA do allow a lot of add backs, et cetera. And so, in a number of cases, you're probably more likely to have a payment default before a covenant default in certain deals. Well, in the non-sponsored space, it really, you have tighter documentation. You're really at the table and having conversations with the company on a regular basis. And so it is a part that we like about the industry. It tends to be more 20 to 25% cushion set to plan. And then the other thing is you do tend to get more true deleveraging in that space. So we think from a credit profile perspective, it's better in a couple of ways. One, there's less leverage on average at inception. Again, PE firms, it's much more normal course to have, 4, 5, 6 times leverage on a loan. Family-owned businesses have a lot less leverage to begin with. But then as they deleverage, as everyone has seen, to help drive the private equity returns, if a company performs and delevers, the initial ask is, okay, let's take leverage back up and let's do a dividend recap. So often the deleveraging that you model in your credit memos, it'd be interesting to back test whether that truly happens in the sponsor case. And while we feel like we do get that true deleveraging in the non-sponsored case, and in an environment like this where growth is maybe a little bit slower and costs are going up, having that conservative credit profile, we really think is very appropriate for the market.
What does the default ratios look like, sponsor versus non-sponsor? Do you track the differences in those two pools?
We do. And we think the right metric to look at is loss rate. And the loss rates between the two are very similar. Now you arrive at it in a different way. Because the covenants are tighter, you will have more defaults in the non-sponsored case, because again, it's a very high threshold to have a default in a PE-backed scenario. But because you're at the table a lot earlier and you can work with a company to take protective actions and corrective actions, you tend to have very strong recoveries. So it's been a similar loss rate across the two. Now, the markets have been benign the last number of years, so I think that will really get tested in the next 3 to 5 to 7 years as we go through a true default cycle. And, we probably haven't had an environment like this for, I'd say, 25 years. A lot of the recent recessions were more deep and sharp, not sort of long and drawn out. And so I think this will be an interesting test of the market. But we'd expect it to be the same. And if anything, we're seeing borrowers be more conservative on the leverage that they take, particularly in the non-sponsored case. And so we'd expect recoveries to continue to be very strong.
And in those where you've had some troubled credits and non-sponsor transactions, how important have been the relationships that you've built with the owner, entrepreneur?
Very, very. And look, it's really, I'd say also their relationship with their constituents. I think we find that family-owned businesses, it's more than just a business. They care about the employees. They're often very impactful in their local communities and the towns. And so I think we've seen really in every case, in the non-sponsored case, that the families have said, if there are bumps, look, we want to put more capital into the business. We want to support it. And so it really, the behavior is truly of a partnership. They're less likely to consider a restructuring, an in-court restructuring. They'll almost, it's typically a negotiated, if anything does go bump, it's negotiated, I wouldn't say amicably, but it's negotiated in a...
Well, it's very personal.
Yes, it's very personal.
It's very personal.
Yes.
It's a family-owned entrepreneur, someone who's built the business.
Yes, their name is tied with their business.
That dynamic, I know in my experiences in dealing with an owner, operator, entrepreneur in those type of circumstances, completely different than dealing with a sponsor. matter, which, by the way, relationships with sponsors are very important, and you look for those that do, quote, do the right thing. Mm-hmm. But there's a different dynamic to it.
Yes. I mean, look, I think just if you look at the numbers, a PE firm can have a meaningful loss in a name and still have a good fund. A family has all their assets.
Can't do that.
No, tied in there. So it leads to the conservatism again on the leverage side, but also I think that they tend to be more constructive in a downturn. So
that must be, from your side of the table, very gratifying to deal with the owner operators where you have a positive outcome in something like that.
Yes. I'd say most of our family founder entrepreneur owned borrowers would say the strength of the relationship was really built when there was some chop, and it's never a straight line. The plans that we get when we're underwriting a deal, we can almost guarantee they won't be they won't be the actual plan. They'll either be better or worse, and there'll be some twists and turns throughout the life of a loan. And really, that's how people behave in challenge times versus good times. It really builds the relationship, and I think based on that even cements even more so the closeness with our borrowers. Well, where again, if they can save 200 basis points with somebody else, they'd say, look, I'd rather have a trusted partner than just look at the shiny object. So.
Right. So how do you think about risk management in the sponsor versus non-sponsor investments?
No, it's an interesting question. I'd say at the highest level, we do think about it similarly, which is we always want what we like to say multiple ways home. So we start by underwriting a company and say, let's assume the worst. Let's assume the cash flows don't materialize. Let's assume there's an unforeseen external shock that neither us nor the company could have anticipated. How do we feel comfortable we still will get a full recovery and that there's value in the asset away from just the cash flows that it generates, strategic value and the like. Now those different ways home will vary from business to business, but we always want to model that not in a theoretical way or in a Excel way, but really what are the paths that we think the company would take if something did go bump to get value back. When you get a level deeper, I think we one of the nice things about being in the middle market versus the lower middle market is a lot of the families that we're dealing with do have the wherewithal of a middle or lower middle market PE firm. So we do diligence their ability to support the company if things do run into challenges. And I think we, again, have actually seen that in almost 100% of the cases in the non-sponsored and probably 80 to 90% in the PE case, where, again, they'll think about it more clinically. They won't put good money after bad if something has really gone off the rails. And then, look, we look for depth of management team. Probably one of the biggest risks in the FF&E space is if everything is really concentrated in a very small leadership team. Now, that is something on the PE side that they will often augment through operating partners and the like. So a lot of diligence on the breadth of the team and really making sure that there's both from a financial support basis as well as a broad leadership team, that there's redundancy in that. And then, we've actually taken a step you see more on the PE side where we partner with a lot of operating folks. They'd be the equivalent of operating partners in a PE context. We don't have the governance, so we don't call them operating partners. But within all of our industry verticals, we have sort of a cadre of operating executives who also help provide a lot of value to the borrowers as we partner with them. And so the nice thing for them is, again, they're getting solicited by PE firms all the time. They want to stay independent. And so we can bring a lot of that value that they would get from a PE firm without having to give up the governance and the dilution.
When you're talking to the CEOs and founders and entrepreneurs that you've invested in, what are you hearing from them in terms of the challenges that they're facing today in today's economy?
Yeah, well, there are a number, and really it was after a long period of low rates and a fairly benign, most of last decade. It's really been quite a different experience in the last couple of years. There's probably three pressures they're facing significantly. The first is rising interest rates and borrowing costs. So we went from a decade of near zero base rates or risk-free rates, and now the risk-free rate is sort of in the mid-single digits and even a little higher in some instances. Adjusted adjusting to a higher interest rate environment is a key concern for a lot of our portfolio companies. Second piece I'd say is wage inflation. The great exodus from the workforce really impacted, and it's not just the cost of labor, but it's the availability of labor in the marketplace. And so, I think companies are paying up to keep their best people and their best talent, and that puts pressure on the cost line. But it's a very good investment, because particularly if you have a skilled employee base, that's very hard to replace, very costly to replace, even in a looser labor market, but even more so in the current conditions that we find ourselves currently. And then I'd say the third is just the general inflation, non-wage inflation, where the cost of inputs is going up. So it's really, we spend a lot of time on underwriting our portfolio companies' ability to at least pass on cost increases into their pricing power in the current environment. Inflation, we feel, is here to stay, but it's really driven by the cost side, and it's just getting passed through to the revenue side. So there's a lot that keeps them up at night. And as a result of that, we try to actually create a lot of forums for our companies to really connect with each other. And in that way, we almost act like a private equity firm in connecting some of our CEOs. Because being the CEO of a family-owned business can be a very lonely position. Mm-hmm. You don't have necessarily the sounding boards, et cetera. Within our industry verticals, we'll often look at talking about best practices, maybe having sessions on cybersecurity or managing change, and some of the things that are top of mind. And it's very nice to see the organic relationships that come out of that. And then again, that's very different than PE lending, where you really don't have that same level of connectivity to the underlying borrower.
That must be very valuable to them, I would think.
Yep. And us as well, because it's always great to hear what's top of mind from their side. So.
Given those pressures in the industries that you tend to focus on, are you seeing any particular trends, or are you de-emphasizing some industries over others?
Mm-hmm. Yeah, it's interesting. Within each of our industries, we have sub industries or verticals that we like and don't like at different parts of the cycle. So even within our industry verticals, we're not generalists. We have areas that we think are better risk reward. For example, in the healthcare space, we're spending a lot of time in the COVID aside, people are living longer, healthier lives, and most of your spend happens after 60 years old. And given the growth of life expectancy, that area of spend is growing at about 25% per annum. And so that we feel is a nice place, even in a flattish economy. We like to spend our time in areas that have clear reasons to grow. In tech telecom, we're spending a lot of time really on the infrastructure and infrastructure services side. That sort of insatiable demand for connectivity, for 24/7 access, for bandwidth, for streaming. That again we feel is independent of some of the headwinds that the economy is facing. So within each of our 5 verticals, we have certain core areas that we really think provide safety and risk return and good risk return in the current environment.
The industry has enjoyed 20 years of very impressive double-digit year-over-year growth. Mm-hmm. When I say the industry, I'm talking about the private credit industry. Where do you see the industry going over the next 5 to 10 years, and where do you see Brightwood's position in that ecosystem?
No, look, it's an evolving landscape. I'd say relative to other areas within private alts, private credit is one of the newer areas. Really, and on the senior context where we play, it's really came of age right after the GFC. So prior to that, it was very nascent. And there are a number of private credit players who go back before then, but they were more in the mezzanine or, as we talked about, the structured space. So true traditional senior direct lending is really that. And so I think what you're seeing is what you typically see in any industry as it's growing. It could be industrials or the like. When there's a new industry, it tends to be above market returns, and there tends to be a rush of players that enter into it. And a lot of the growth was not primary growth, but really was a function of the banks exiting and non-banks and private credit firms coming in their place. So a big rush in. Now I think we're at phase 2, which is where you see consolidation. I'd say the last 2 to 3 years, there's been a significant amount of M&A and the number of players. So less the dollars getting raised than the volume, but the number of players is probably less than half of what it was a few years back. And so I think you will tend to see almost a little bit more of a barbell structure where you'll have a number of larger players and then a handful of mid-sized players. And I think Brightwood, as a mid-sized player in the space, we really like our ability to be nimble and to focus on our end of the market. With all the M&A, a lot of a lot of the larger players, they're not going to sort of get out of bed for a 20, 30, 40 million EBITDA business. They really are looking at the companies kind of 100 million or north. And so in some ways there's been a winnowing out, and so we're seeing, we feel, some of the best deal flow that we've seen, because there are fewer players really focused on what we think of as the core middle market that's there. But we think you'll see this trend only continue. And you can just look at all the reports recently of some of the large transactions that have taken place, and the high level of interest strategics in the area.
I still don't think the industry has been tested in a downturn situation, and so where you've really seen defaults tick up, and maybe that's a testament to the industry in terms of their capacity to manage the portfolios and make good underwriting decisions. But I would have expected to see a little bit more stress than I've seen.
I would agree with you. I mean, I think the last really true drawn out recession was really the early 90s, which unfortunately I'm old enough to remember.
You and me both.
Yes, but it's so I think what we have seen are a number of sharp and deep shocks, but they tended to be shorter, whether it was the tech correction, whether it was GFC, whether it was COVID. You go down the list. So I think we agree. It probably will also cause a winnowing out in the industry, which once that does happen, because it has been such a long time. But we underwrite to the downside case, and so while some players are pulling back in the current environment, we don't think we can truly say we underwrite to the downside case. And when there's choppy water, say, oh, we can't underwrite.
Right.
Well, then something we were saying before was off. So but we try to underwrite our loans conservatively, and we feel that protects in the current environment.
So this has been a great conversation. I really appreciate it. I just have a couple wrap-up questions, if you will. Firstly, as you know, the asset management industry isn't known for diversity of women or minorities, and I'm wondering what diversity means to Brightwood.
Well, look, we think it's critical to being good stewards of capital. So, and we look at diversity on all levels. First of all, we really want diversity of background on our team. We have folks who, on our origination side, who built their career on the restructuring side and come to the certain. We've had some who have been actually entrepreneurs and business owners on their way as well. So whenever we look and sit around and talk about a credit, we want people coming at it with as many different thought patterns as possible. And I think if you find firms where everybody's sort of from a certain DNA, I think you'll only get one perspective. You'll get that very strongly, and that could be a very good perspective. But we think there's variety in looking at things as many different ways as possible. From the traditional diversity definitions, we think that is critical as well. What I like to say is our team reflects the diversity of New York City, which is where we happen to be headquartered. So we're probably as you pointed out, the industry has not been very diverse historically, and I think private credit has been one of the least diverse areas in the landscape. I think anecdotally, what we've been told is in terms of firms whose primary focus is senior direct lending in the U.S., we're the only firm who's north of $1 billion of AUM that's either majority woman or minority owned, focused on that space. But it's much more than the ownership. It goes down to the team. Our team is 50% diverse, 40% women. But it's just that that broad perspective, that that ability to look at things from as many different angles as possible, and to relate to as many different people as possible. I mean, both the investors that we serve, the clients that we serve on the investment side. Again, our team looks probably a lot more like their beneficiaries if you think about some of the large pension plans, et cetera, and also matches the diversity that you often see within our companies that we lend to. And so there is a relatability that's there that you don't often see, we think, in other areas. But look, we're credit folks, so we want to look at things from many different angles as possible. We're glasses half empty by nature, and so we do like that, and we think it's critical, and we think it's a key advantage that we have in the marketplace.
So what do you do to relax in your off time and take your mind off the business?
So, well, there's not much time to do that, but
well, you're an entrepreneur like those that you invest in, and so I can imagine it doesn't allow for a lot of time.
Yes, no, and that is it's interesting you touch on that. That is one of the things that does resonate with the family-owned businesses that we lend to versus some of the mega shops where there's a relatability of, look, we are an independently owned business. We have to do all the things you do, make payroll, make strategic planning decisions, et cetera. But no, look, I think first and foremost, it's spending time with family, with my wife, with 2 teenage kids who we probably want to spend more time with them than they do with us, but that's normal at the time. And then look, we enjoy traveling. We think the more places you see, the smaller you feel, but again, the broader perspective that you have. So it's something my wife and I love to do. When we do get moments, we like to try to see different places and different cultures and learn and grow from them.
Well, this has been fantastic. I've certainly learned a lot from this conversation, and I appreciate you taking the time to be with us on Private Market Talks.
Well, thank you, Peter. Enjoyed it.